welcome to the Property Wealth Podcast. I am Sarah Mitchell, and today we're diving into a really important topic for anyone looking to build wealth through real estate, and that's over-leveraging, when debt becomes dangerous.
Yeah, it's a crucial conversation, Sarah. Many people think leveraging debt is the way to grow their investment portfolios, but it can be a double-edged sword.
Absolutely. I mean, it's so easy to get caught up in the excitement of buying properties and expanding your portfolio, but if you're not careful, it can lead to some serious financial trouble.
Right, and we're going to unpack that today. We'll talk about what over-leveraging really means, how to spot the warning signs, and, of course, how to avoid falling into that trap.
Plus, we'll share some practical tips on how to manage your debt wisely, and how to leverage it effectively to actually build wealth instead of risking it.
Exactly. And we'll also touch on some real-life scenarios, what worked for some investors and what didn't. That way, you can learn from their experiences.
Sounds great. So whether you're just starting out or you've been in the game for a while, this episode is packed with valuable insights.
Let's get into it.
Yes, let's dive into the world of over-leveraging and how to navigate it smartly.
So, Sarah, when it comes to real estate, the stakes can feel pretty high, especially for those of us over 40. I mean, we're often thinking about retirement timelines and how we want to secure our future, right?
Absolutely, Mike. And that's a big part of why over-leveraging can be so risky at this stage of life. It's not just about the here and now. It's about what we're leaving behind and how we're preparing for those later years.
Exactly. If someone's heavily leveraged and the market shifts, it can really shake their plans. I've seen investors who've put everything into a property, thinking it's a surefire win, only to find themselves in a tough spot when, say, interest rates rise or the market cools. It's like, suddenly they're not just dealing with monthly payments, they're facing potential negative equity.
Right, and that can be a wake-up call. I remember a story of a couple. Let's call them John and Lisa. They were in their early 50s and had taken out a big loan to buy a second property, thinking it would be a great investment to fund their retirement. But then the market took a downturn, and they found themselves paying more than the property was worth. It was pretty stressful for them.
Yeah, that's a tough situation. And, many people in that age group are also planning to pass wealth down to their kids or grandkids. If they're over-leveraged, it can really impact what they can leave behind. It's like, instead of being able to help with a down payment for a first home or pay for education, they're stuck trying to manage their own debts.
It's so true. And then there's inflation, which is, well, a real concern right now. With rising costs, it can feel like your money is just slipping away. Property, when managed wisely, can be a hedge against that. But if someone's too far in debt, they might not be able to capitalize on that.
Definitely. A lot of folks might think, I'll just hold on to this property and it'll appreciate. But if they're stretched too thin, they can't take advantage of that appreciation because they're constantly worrying about making the mortgage payments.
Yeah, and that leads to a lot of emotional stress. I've talked to investors who, when they're over-leveraged, feel this constant weight on their shoulders. It can affect not just their finances, but their mental health too. It's like the dream of financial security turns into this overwhelming burden.
You hit the nail on the head. I once spoke with a guy named Tom, who had a couple of properties but was really feeling the pressure. He'd been trying to juggle multiple loans, and it affected his ability to enjoy life. He was missing out on family gatherings, even vacations, because he was so focused on making ends meet.
That's such a tough place to be in. And it's a reminder that property investing isn't just about the numbers. It's about the lifestyle you want to create. If your investments are holding you back, then what's the point?
Exactly. And, the current economic trends are shifting rapidly. With interest rates rising and market volatility, it's crucial to have a clear strategy. People over 40 should be thinking about how to protect their assets, not just grow them.
Yes. And there are ways to do that, like diversifying investments, keeping some liquidity, and not putting all your eggs in one basket. I think a lot of people are starting to realize that it's about balance.
Right. And for those who are feeling the pressure of debt, it's okay to take a step back and reassess. Maybe it's about selling a property or refinancing to get a better rate. There's no shame in adjusting your strategy.
And that can be empowering, right? Realizing that you have options. I think sometimes people feel trapped by their decisions, but there's always something you can do to pivot.
Totally. And for those looking to build wealth, It's about creating a solid foundation now so they can weather any storms that come. It's not just about making a quick buck, but building something sustainable.
Exactly. And as we move into the core strategies, I think it's important for listeners to keep that long-term vision in mind. It's about crafting a portfolio that not only serves them now, but also secures their future and their family's future.
Yes. So let's dive into some practical ways to navigate this landscape without falling into the trap of over-leveraging. So let's dive into some core strategies and rules of thumb. These can really help when you're looking at potential investments, especially when you want to avoid over-leveraging.
Right, and I think a good starting point is the 1% rule. Can you explain that a bit?
Absolutely. The 1% rule is pretty straightforward. Basically, it suggests that a rental property should generate at least 1% of its purchase price in monthly rent. So, if you buy a property for, let's say, $200,000, it should ideally bring in about $2,000 a month in rent.
That's a great benchmark. But, what if you're in a market where rents are lower?
Good question. In those cases, you might need to adjust your expectations. Look for properties that still offer good cash flow, even if they don't hit that 1% mark exactly. It's about balancing your investment with local market conditions.
Yeah, and I guess that's where doing your homework comes in, right?
Exactly. You want to analyze the market trends. Look at comparable properties and see what they're renting for. It helps you gauge whether a property is a good deal or not.
I've heard about the 50% rule too. Can you break that down for us?
Sure. The 50% rule is another handy guideline. It suggests that, when calculating potential profits, you should expect about 50% of your rental income to go toward expenses, like property management, maintenance, taxes, and insurance. So, if you're bringing in $2,000 a month, you should budget about $1,000 for expenses.
That makes sense. A good way to ensure you're not overestimating your cash flow.
Exactly. And then you can really figure out how much profit you might have left over. But remember, it's just a rule of thumb. It's important to dig deeper into your actual costs.
Right. So what about cap rates? I know that's a big one in real estate investing.
Cap rates, or capitalization rates, are another key metric. It represents the return on investment of a property, calculated by taking the net operating income and dividing it by the property's purchase price. So, if a property generates $20,000 a year in net operating income, and you buy it for $200,000, your cap rate would be 10%.
That sounds pretty good. What's considered a good cap rate, though?
Generally, a cap rate between 8% and 12% is considered attractive, but it really depends on the market and your investment strategy. Higher cap rates often mean higher risk, though, so it's about finding that balance.
Got it. And for someone just starting out, how would you suggest they go about evaluating a property deal?
A solid deal evaluation checklist can be invaluable. Start with the basics: the purchase price, potential rental income, and the estimated expenses. Then, look at the property's condition. What repairs or renovations might be needed?
And you'd want to factor in those costs, right?
Absolutely. Don't forget to account for any unexpected repairs. It's always wise to have a contingency fund. A good rule of thumb is to set aside about 10% of your gross rental income for maintenance and repairs.
That's a smart way to avoid surprises down the line.
Right? And then, after you've assessed the numbers, think about the property type. Is it single family, multifamily, or maybe a commercial space? Each type comes with its own risks and rewards.
What about financing options?
That's a critical piece of the puzzle. Traditional mortgages are common, but you might also consider options like hard money loans or private lenders, especially if you're looking at a fixer-upper. Those can be quicker to close, but usually come with higher interest rates.
Yeah, and it's important to understand your financing costs too, right?
Exactly. You need to factor those costs into your cash flow calculations, and always shop around for the best rates and terms. A small difference in interest can add up significantly over time.
So what's your advice for someone looking to get into different property markets?
First, research is key. Look at economic indicators, job growth, and population trends in various areas. Those factors can give you an idea of future demand. Invest in markets that show stability or growth potential.
And wouldn't it be wise to visit those markets too?
Definitely. You want to get a feel for the area, meet local real estate agents, and maybe even chat with other investors. It's all about building that local knowledge.
That sounds like it could be really eye-opening. Now, with all these strategies and rules of thumb, it seems like you can really set a solid foundation.
Absolutely. But it's essential to stay aware of common pitfalls as well. Even with all the best strategies in place, there are traps that can lead to over-leveraging.
Right, and I think that's a critical point to touch on. What are some of those pitfalls that investors should watch out for?
Well, one major pitfall is getting too caught up in the numbers and ignoring the emotional side of investing. It's easy to overlook things, like a property's condition or the neighborhood's vibe when you're focused solely on cash flow.
That's such a good reminder. Sometimes it's not just about the potential profit, but also about the quality of life in that investment.
Exactly. And then there's the risk of taking on too much debt. It can seem tempting to leverage as much as possible, but that can lead to financial strain if things don't go as planned.
Yeah, and maintaining a balance is so important.
Right, and keeping an emergency fund is crucial too. You don't want to find yourself in a tight spot if unexpected expenses arise.
So staying informed and cautious really helps mitigate those risks.
Exactly. Always evaluate your investments carefully and don't rush into decisions.
Great insights, Mike. I think we've covered some solid strategies, and it's clear that a thoughtful approach can really pay off in the long run.
Definitely. Let's keep that focus on practical tips as we move forward. Sarah, one of the most common pitfalls I see investors fall into is over-leveraging. It's like the excitement of getting that next property can sometimes cloud our judgment, right?
Absolutely, Mike. It's easy to get swept up in the rush. But what happens when you take on too much debt?
Well, I've seen it play out in so many ways. One investor I knew, let's call him Tom, he was really eager to expand his portfolio. He bought several properties using high-interest loans, thinking he could refinance later when the market improved. But he didn't account for the fact that the market could go down.
Right, and then what happened?
Exactly. The market shifted, and suddenly those properties weren't worth what he paid for them. He was stuck with high payments and no way to refinance. It felt like a perfect storm,
That's such a tough situation. So what advice do you give to avoid that kind of trap?
Well, first off, I always stress the importance of having a solid cash flow plan in place. Make sure you're not just looking at the potential rent income, but factoring in all your expenses.
Yeah, like maintenance, property management fees, everything.
Exactly. Hidden costs can really sneak up on you. Another investor I know, let's call her Lisa, she bought a property that seemed like a steal. But then she discovered a ton of hidden issues, like, roof repairs and plumbing problems that weren't disclosed.
Ouch. So that must have eaten into her cash flow significantly.
You got it. Instead of a positive cash flow, she was drowning in expenses. It's essential to do thorough inspections and maybe even budget for unexpected repairs when you're analyzing a property.
And it's crucial to have a contingency fund, right? Just in case something goes wrong.
Absolutely. A general rule of thumb is to set aside at least 10% of your rental income for unforeseen costs. That way, you're not caught off guard.
That's such a good point. What about bad tenants? They can really throw a wrench into your plans, can't they?
Oh, for sure. Bad tenants can be a real nightmare. I had a client, let's call him Jake, who thought he could manage his properties without screening tenants properly.
That sounds risky.
Yeah, it really was. He ended up with a tenant who didn't pay rent for 3 months. By the time he managed to evict them, he was already in a deep financial hole.
So much stress, too. I can only imagine.
Exactly. What I recommend is to always conduct thorough background checks and reference checks before signing a lease. You want to know who you're dealing with,
Definitely. And speaking of timing, what do you think about investors trying to time the market?
Oh, timing the market can be a slippery slope. I had a colleague who was convinced the market was about to crash, so he hesitated to invest for months.
And did it crash?
Nope, it actually went up, and he missed out on some great opportunities. The market is unpredictable, and waiting for the perfect time can lead to missed chances.
That's a good reminder that sometimes it's better to just get in, rather than wait for the ideal moment.
Right. Focusing on your investment strategy and sticking to it is often more effective than trying to guess market movements.
And let's not forget about cash flow again. Ignoring it can lead to serious consequences, can't it?
Definitely. I've seen investors so focused on appreciation that they overlook cash flow. A guy named Mark, for example, bought a property in a hot neighborhood, thinking it would skyrocket in value.
But
His expenses were so high that he was barely breaking even. When the appreciation didn't happen as fast as he thought, he was stuck in a tough spot financially.
that's a perfect example of why you need to keep an eye on cash flow. It's the lifeblood of your investment.
Exactly. And if you ever find yourself in a situation where cash flow is tight, it's important to act quickly. Consider adjusting rents, or if necessary, look at selling a property that's not performing well.
That's a proactive approach. So what are some red flags investors should look out for when it comes to over-leveraging or, any of these common pitfalls?
Great question. One major red flag is if you're stretching your finances too thin. If your debt-to-income ratio is getting too high, it's time to reassess. Also, if you find yourself constantly worrying about making ends meet or struggling to cover expenses, that's a signal something's off.
And what about potential properties? Any signs to watch for during your search?
Sure, look for properties that have a history of consistent rental income. If you see a property that's been vacant for a while or has had multiple owners in a short time, you might want to dig deeper into the reasons why.
Yeah, it could be a red flag for bigger issues.
Exactly, and it's also essential to understand the local market trends. If a neighborhood is declining, it's probably not the best place to invest, even if the price seems right.
So it really comes down to doing your homework, doesn't it?
Absolutely. Knowledge is power in real estate investing. The more informed you are, the better decisions you'll make.
And if someone finds themselves in a tricky situation, like over-leveraging or bad tenants, what's the best course of action?
Well, first, don't panic. Take a step back and assess your situation. Consider consulting with a financial advisor or real estate professional who can help you get back on track.
That's good advice. And sometimes it might even mean reevaluating your portfolio or making tough decisions, right?
Exactly. It's all about being proactive and not reactive. Learning from your experiences, whether good or bad, can help you grow as an investor.
Such a valuable insight, Mike. Thank you for sharing these lessons and strategies.
You know, Sarah, when we talk about over-leveraging, it can feel a bit overwhelming, but there are definitely actionable steps folks can take right now to set themselves up for success.
Absolutely, Mike. It's all about starting where you are, right? So what do you think is the first step someone should take?
Well, I'd say the first thing is to take a good, hard look at your current financial situation. Understanding your debt-to-income ratio is crucial. There are plenty of online calculators for that.
Right, like the Bigger Pockets calculator, which is super user-friendly. That can help people see how much debt they can realistically handle without putting themselves at risk.
Exactly. And it's not just about looking at numbers. It's also about analyzing your cash flow. If you haven't already, try using an app like Rentometer to evaluate potential rental income. It gives you a good sense of what similar properties are renting for in your area.
That's a great tip. And I think it's also important to set a goal. Maybe aim to analyze one deal per week. That way, you're consistently getting into the habit of evaluating properties without feeling rushed.
Yeah, and keeping that pace can help build confidence. Plus, joining a local real estate meetup can be a game changer. Connecting with others in your area can provide insights and support that you might not have expected.
Oh, for sure. And on that note, there are some fantastic resources out there. I'd recommend books like Rich Dad, Poor Dad for mindset shifts, and the book on rental property investing by Brandon Turner for practical strategies.
Those are solid recommendations. Podcasts can also be a great way to learn on the go. Besides ours, of course. Bigger Pockets podcast is a staple for many investors. Lots of real-life stories and actionable advice.
Yeah, I love how they share different perspectives. And speaking of perspectives, it might be useful to get familiar with tools like Zillow or local MLS access to keep an eye on market trends.
Definitely. Staying informed about your market is key. And I think it's also worth mentioning the importance of building a strong support network, maybe even a mentor. Having someone to guide you can really make a difference.
That's true. And don't forget about setting up a financial plan. Even if it feels daunting, starting small is better than not starting at all.
Right. And it doesn't have to be perfect. Just take action. Maybe even put together a simple checklist of what you want to accomplish each month.
I like that idea. Keeping track of your progress can be motivating. And if you hit a bump in the road, don't get discouraged. Just adjust and keep pushing forward.
Absolutely. Remember, it's a journey, not a race. And if you ever feel overwhelmed, just break it down into smaller, manageable steps.
So to sum it up, you've got tools, resources, and a community to lean on. Plus, the mindset to keep learning and growing.
And with these tools in your pocket, you're ready to move forward. Let's recap what we've covered today. So, as we wrap up this episode, let's just quickly recap some of the key points we discussed about over-leveraging.
Absolutely. One major takeaway is, understanding your debt-to-income ratio. It's crucial to keep that in check.
Right. And we talked about the importance of having a solid cash reserve, too. That buffer can really save you when unexpected expenses pop up.
And let's not forget about the significance of being realistic about your investment goals. Setting achievable milestones can help you avoid that slippery slope into over-leveraging.
Exactly. And we also touched on the value of seeking professional advice. Sometimes it's worth it to consult with a financial advisor before making big moves.
So true. Those insights can really steer you clear of potential pitfalls. Building wealth through real estate is a journey, and it's all about making informed decisions.
Yeah, and remember, it's not just about acquiring properties. It's about understanding the financial landscape and ensuring you're set up for long-term success.
For sure. So if you found value in today's discussion, we'd love for you to like and subscribe to the podcast. And hey, if you have a big takeaway or a question, drop it in the comments.
And if you know someone over 40 who's looking to invest in property, share this episode with them. You never know who might find these insights helpful.
Absolutely. Next time, we'll dive into a topic that many investors face: bad tenants. We'll share some stories and tips on how to prevent those situations.
That sounds like a good one. Can't wait to explore that with you, Sarah.
Me too, Mike. Thanks to everyone for tuning in today. Remember, building wealth takes time, but with the right strategies, you can do it.
Take care, everyone, and see you next time.